These are financial terms that every beginner should know. Let's get right into it. Number one, stock. A stock is a share representing ownership in a company. So obviously a company will issue out, let's say, 10 million shares, 10 million, and then you buy a few shares because obviously, these are massive companies. You buy a few shares, then the amount of shares you have is direct representation into the percentage of the company you own. So you have partial ownership in any company if you buy stocks within that company. Let's go right to dividend. A portion of a company's profits paid to shareholders. So let's say you buy stocks, you buy shares, you buy ownership into a company. Then that company pays you a dividend for owning shares of that company. They're like, thank you for believing in us. Thank you for investing to us. Thank you for being a part of us. We're going to now dish out some of our profits back to you, the shareholder. Let's go to bull market. A market condition where prices are rising or expected to rise. Bull markets are good. That's when things are going up, things are rising, things are still expected to rise, things are looking good. Everything's in the green. Everything is projecting upward. And a bear market is the exact opposite. Bear market is a market condition where prices are falling or expected to fall. These are different. There's cycles in the market. So not necessarily, the end of the world if it's a bear market or a bull market, because either or, both of them are going to happen. It just happens at different periods depending on what's happening in the markets. Let's go into portfolio. A collection of financial assets like stocks, bonds, or cash. Portfolio is basically all of your different financial assets put together, kind of like organized neatly, not literally, but theoretically. Like, for example, you have 10,000 cash, you have 5,000 in stocks, you have 3,000 in bonds, you have 1,000 in crypto. That's your portfolio. Your money consisting of different things in the different areas that you have it invested in. Let's go into index. A benchmark representing a segment of the market. Example, S&P 500. So indexes, there will be companies with these massive networks, computers that track. They'll have an index that tracks, let's say, a certain sector of the market. Like, for example, the S&P 500 is the 500 biggest companies in the U.S. market, U.S. stock market. So the index will forever just simply track the top 500 companies of that and will give numbers and everything according to that. Let's get to blue chip stocks. Shares of large established and financially stable companies. Blue chip stocks are the biggest companies you could think of. Apple, Coca-Cola, Amazon, those are all blue chip stocks. The most expensive, the biggest conglomerates in the world are blue chip stocks. Market capitalization or market cap, the total value of a company's outstanding shares. So all the money invested into one company in totality is their market cap. Every single dollar that everyone has in that company invested is it will equal to a company's market cap. Let's go to IPO, the initial public offering. The first time a company offers shares to the public. So obviously, companies are already well established before they even go into the stock market and get the IPO, where they initially offer themselves up to the public. A lot of companies are already, like for example, Chick-fil-A. Chick-fil-A is already a company that's been out for years, and people love it. People shop there, but they're not established on the stock market because they never had an IPO. They never went public. They're like, all right, we want the public to buy our shares to get ownership of this company. They're like, no, the ownership, we rather have 100% of the company. We want to own the company. We don't want the public going in and buying and messing the price up. And so that's IPO. Last but not least, ETF, exchange traded fund, a fund that holds a collection of assets and trades on an exchange. ETFs are indexes if index was investable. So ETF is basically the same thing. It tracks a basket of stocks. An ETF can have 500 different, just like the S&P, there's ETFs for the S&P. 500 different companies into one stock. You're investing into this one thing, but it holds 500 different companies. And your money is evenly divided amongst all the different stocks in any given ETF. ETFs are ways to invest safer, to hedge against bad times in the market, and it's just a safer overall pick. These were some simple terms that every beginner should know. We'll make another video going into more terms. I hope you enjoyed the video. Have a great day. Good luck on your financial journey. Peace!